want to talk to you now about some of the disadvantages of crowdfunding from the perspective of the investor. Now, the first thing to say is that nothing in this video constitutes financial advice. You really must make your own mind up, and if you're going to make investments, then take your own financial advice. I'm simply offering you here some principles and some points that you should bear in mind when doing it. But I also want to do this video because I want to get a balanced approach for you as a potential investor. The first thing to say, of course, is that early stage businesses are higher risk businesses, and that is inherent in their nature. Studies have shown that up to 35% of them can fail. Half of them, including the 35%, produce returns of less than 1 times your investment, but the top 5% can return more than 30 times your investment. So you should actually take a diversified and portfolio approach if you're looking at this. You can lose your investment, and you must be aware of that, and that is true of any early stage investment, indeed any investment at all potentially, but particularly so with early stage investments. So the best way to do this is to actually have a portfolio of 10 or 20 of these companies, and therefore you accept that some of them will fail, but you hope that some at the other end of the spectrum will produce you outstanding returns, and that overall your returns will actually look quite good. You have to bear in mind that in rewards-based crowdfunding, there is still a possibility, even if the crowdfund is successful and the money is raised, they still may not at the end of the day deliver the product or the reward or whatever else they've promised. So that is definitely a risk you have to bear in mind. And in equity crowdfunding, the company may still, despite the fact that it's funded and the money's gone in, they may still not develop on the promises they made at the time of the crowdfunding. Of course, early stage businesses are by their very nature illiquid. So there's a lack of liquidity here. Once you've made your investment, it's very difficult to get your money back. And you really have to take a multi-year time horizon when considering investments of this nature. Now, the quality of these companies can be called into question. I'm not saying that they're all not of the highest quality, but you are nonetheless taking a risk because there is less due diligence done by the platform. The requirements to list on some of these platforms are lower than you would have if you were listing on a stock exchange, and therefore you cannot rely on the rigorous due diligence having been done by financial advisors and other people. There will be due diligence done by the platform, but I strongly advise you to do your own due diligence before making any sort of investment. And of course, you have to accept that small companies come with a major risk warning, and this is it. Investing in small public listed or private companies does involve risks including illiquidity, lack of dividends, loss of investment and dilution, and it should only be done as part of a diversified portfolio. So there you are, that's laying it out, warts and all, the disadvantages of crowdfunding for investors, but I want you to have a balanced view before you even consider jumping into the crowdfunding pond.